What's up, everybody? Michael Silva here. The stock market volatility has been ramping up, taking out some of the bigger market cap leaders. And the stock market has a risk-free competitor that we're going to be talking about. The volatility has been absolutely wild. Just yesterday, the Qs were down 2.45%. That was the largest single-day drop in the year 2023. The time prior to that was right over here towards the end of 2022. We got a lot to talk about on today's Stock Market Brief, where we navigate the financial markets through the lens of technical and financial market analysis. If you haven't done so already, make sure to hit that thumbs up. It is greatly appreciated. Let's hop into today's show. All right, everybody, welcome back. We're going to start off here looking at the 11 sectors that make up the S&P 500. The two right over here are really rate sensitive, and they're typically more risk off, at least utilities over here. And well, what do you know? What took place with yields? Well, yields backed off once again, seeing some large body candles as it's at the upper end of its range over here. Are we just consolidating for potentially a larger move, or are we starting to see something where the price momentum oscillator is diverging from the price action of the TNX, the 10-year yield, and the RSI is diverging too? So are we going to be potentially taking a little bit of a back seat, potentially maybe even coming back down to 46 or 4.6 on the 10-year yield? All right, well, we shall see. I will say that the heat map today was pretty red, right? The big market cap leaders were down pretty severely. Tesla was down 3%, Microsoft down 3%, and so forth. However, year to date, there's still a lot of room for these to potentially fall. Microsoft is still up 36%. Google's still up 39%. Tesla's still up a whopping almost 70%. And NVIDIA's up almost 200%. That's absolutely bonkers. Now, there has been a rotation into safety assets in the month of October. And October's typically could be more based off of seasonality, a more bearish type of month. And then as we come into the year end, you typically get a little bit more bullish seasonality. So is that what we're seeing, or are we starting to see the rotation into safety assets? If you take a look at gold over S&P 500, this is a massive move. And I'm going to come back to this because the move's happening while another asset that typically has a negative correlation is performing well too, which kind of feeds off the risk off narrative. Utilities over S&P 500, we're starting to see that pick back up above the 50-period EMA. So we're seeing strength there. What these lines mean, if you're new here, if you don't know what these lines mean, when these go up, it means the asset that I'm tracking is outperforming the S&P 500. And the assets that we're tracking is gold, utilities, consumer staples, TLT, and healthcare. Healthcare is rather flat line, but it is above that 50 EMA. And then TLT has been in this massive crash mode relative to the S&P 500 and absolute, but we are starting to see it pick up a little bit here, coming back up to the 50-period EMA, which it has not actually touched or tested really since May, right, from it breaking down in May earlier this year. Okay, if you take a look at these, this is the Magnificent Seven relative strength lines plus Netflix. We can just forget about Netflix. It's not that large of a market cap. We're going to take a look at Meta, Apple, Nvidia, Google, Microsoft, Amazon, which just reported after the bell. It was up, then it was down, and then it was up again. It's crazy. Meta just kind of has been pointing down, right? So it's still in an overall uptrend, but it's starting to kind of bleed out here. You see Apple, it's breaking down from the 50-period EMA. Nvidia, it's breaking down from that 50-period EMA, but rather flat. Google took a big hit on earnings. Microsoft, right? This is one of the more bullish ones as it's pulling down slightly. Amazon's down underneath it to relatively flat. Netflix, you can look at this or not, but we had a good earnings and it's back above that. And then Tesla has been beaten down too. So we're seeing a rotation clearly here. Okay, this is not just me speculating or narrative. We have the big mega cap names. We're seeing rotation out of them, and we're seeing rotation into safety assets. And the reason why I wanted to come back to gold was because if you look at the dollar's been rising, and gold's rising with it, which is a pretty rare occurrence. It happens every once in a while, but it's typically more of a bearish scenario for the overall markets. If we take back a look at the 10-year yield, we talked about those negative divergences forming. So if potentially this falls off, that means that the bond trade may still it might be able to break through this 50 EMA, and we might start to see more relative strength here. Now, that doesn't necessarily mean that that's going to benefit all of these names. It could temporarily, but remember, there have been times throughout history where a flight to safety in yields or in bonds does not necessarily mean that the market follows. Okay, we'll continue on and look at another important asset or commodity. That's oil. Oil is still remaining breakdown mode from this little bear flag. If it's going to be a full measured move, that can take it to around that 200 period daily moving average, which is it's right around 78 as it stands. But you can see we had a nice bullish day and then followed through today with some downwards momentum. And we called out this bearish divergence, and we talked about how the RSI was getting overbought over here, and then it was also pulling into a prior area that was resistance, and that clearly held. Okay, if we take a look at the S&P 500, we still have a series of lower highs and lower lows, so the trend right now remains down, and we're back in this chart I showed a long time ago. And I'm bringing it back because we really showed it a lot here and throughout this period. And the reason why is because this range acted just like as magnetic type levels. And we broke down through 4,200, which is a key gamma support level. Okay. And it broke down, or as a put wall, broke down. And you saw a big flush through that level, tagging into the weekly expected move. So this little dash line over here is this week's expected move. So the market's doing exactly what the market said it could potentially do, and it's just kind of hanging out there as it stands. But if you look to the left of the screen, where are we? Well, we're all this volume traded and all this exposure, right? This implied volatility, gamma exposure, boom, we saw this massive breakout when we got back above 4,200. So are we going to continue to chop around in here? Are we going to find support? We're beneath the 200-day moving average. So right now, yeah, you got to be a little bit more cautious. You can play tactical bounces. I'm a fan of playing tactical bounces, but you just got to be aware of the overall situation. When you're below a 200-day, it is still inclining. So that's, positive, but you want to see a quick recovery, right? And then you want to get back above this prior swing high. And the reason why you want to get above this high is because that would change the narrative of lower highs, right? You see a high, lower high, lower high, lower high, and then all of a sudden if we bounce, we're like, oh, okay, well now we have actually a higher high. So if price comes all the way back down and it doesn't take out this low and it bounces, well, then now we say, oh, well, now we have a higher high and a higher low. So that right there would be a bullish scenario despite seeing this as it stands. So even if we come all the way back up to 4,300, okay, in a few weeks' time, we still would have to close above that high right there, which, obviously, would be one heck of a move in a short period of time. And this is happening on the back while the Fed is still remaining to tighten, right? So when they tighten, it brings in more volatility. You can see over here, this was during the banking crisis, that quick little blip on the screen where they, boom, shot the balance sheet right back up. And that actually happened to coincide with a nice rally over here. But you can see they followed suit and started continuing to tighten, and we're starting to see that volatility settle in here. If we take a look at rates of where the Fed Watch tool sees them potentially cutting rates into the near future, that's still in the back half of next year. So in June, so higher rates for longer is what the market's kind of pricing in as it stands. If I show you the Bank Term Funding Program, when this actually took place over here, they initiated the Bank Term Funding Program, and you can see the markets were kind of selling off. And as soon as that thing hit, bam, the market also rallied through this area. So the reason why I'm showing this is because if the Fed acts, right, if the Fed Reserve responds to a situation, or if something snaps, something breaks where they need to step in, this could be a potential opportunity for just various different trade setups. So it's something that we got to continue to watch. And this is also happening while credit growth is still contracting. So if we're taking a look at this, you can look back through all the way out through the 1975, right? This is as far as the chart goes back. But every time that we have a recession, these gray shaded lines, what preceded that was credit growth contraction, credit growth contraction, credit growth contraction. And I want to kind of call, more close into this area. And the reason why is because you can see, just because we have credit growth contraction doesn't necessarily mean that there's going to be a recession. But if I zoom into 1985 all the way to 20 where we are now, okay, what you'll notice here is I applied the 10-year, 2-year Treasury curve. Okay, so the yield curve over here, and that's in red. You'll notice while it inverts, which we are currently inverted at this time, as we're moving through the uninversion, which, by the way, a yield curve that's inverted is typically one of the best recession predictors that can happen in the potential future. I mean, believe it or not, people always, this time's always different, but it's never actually been different. So, we'll see when it uninverts. But as you can see, as it uninverts, what is credit growth doing? Credit growth is contracting during that same period of time. While it uninverts, it contracts. Okay, something breaks, right? Typically, the Fed steps in, and you can see the gray shaded area recession. In 2000, we were inverted. We uninverted. What was credit growth doing? Well, we landed in a recession. 2007, right? 2006, we started uninverting. Credit growth was contracting, ended up in a recession. Same thing over here, very tight little blip over here. We were contracting slightly, and was we uninverted. Well, the Fed stepped in during this recession, and boom, credit growth contracted there. And now what do we got going on? Well, we're deeply inverted, right? We've the most inverted that we've been dating back to the 80s. And if you take a look over here, what you're noticing is credit growth is contracting. So if we come out of this, inversion, are we going to see credit growth contract, and is it going to lead to what exactly it led to, here, dating back to the 1990. Now, a lot of people like to look at the 10-year, 2-year. I know the Fed said that the Fed staple now, after this inverted, it was no longer important. The 10-year, 3-month is the important one. Oh, my goodness, right? Well, this is where we were. We're 175 basis points inverted. Well, we're starting to uninvert where we're, where are we? Around 75-ish basis points inverted. I don't have the exact number. But you can see that's where we are now. Okay, but this is where we were in the 2020 recession, greatfinancialcrisis.com in 1990. So the reason why I'm telling you this is because there's a lot of market volatility. A lot of market volatility can bring on opportunities, but the stock market has a huge competitor, and the competitor is you can get they say the average return in the stock market is 8 to 9% a year, right, through the course of time. But if you can go into something that's risk-free for 4% to 5.5%, 6%, say something like here, Vanguard Federal Money Market Fund, right? You can literally compete with the stock market, a few points off of whatever recent history was for practically risk-free and get a really good yield. But it's not just that. You can go into a savings account. This is a performance saving from Capital One. It's 4.3. The reason why I'm showing you this specific one is because I have money in this savings account personally. And no, it's not sponsored. But that'd be cool if Capital One wants to sponsor me, dude. There's other funds like TBIL. This is a Treasury 3-month, right? You get the yield right now, according to stock charts, is 4.45%. T-Flow, which is 4.46. And then my largest position, at least in my Fidelity account, has been FDRXX, which is giving me like 5% or so. Yeah, 5%, I believe it is, yield right now. So it really comes down to, how you want to manage your money. I understand, like, I still swing trade, I take trades, but it's a lot smaller portion where the bulk of my money, I don't want it to be in this very volatile environment. I want to save and grow it because rates are high. And I could show you this by looking at the federal funds rate. I'm kind of give you an example as to really what I mean. Now, from 2009 to 2016-ish, 2015, we basically had rates down to zero, right? And what did this encourage? This right here, when rates are really low like this, it tells us that money's cheap, right? If money's cheap, people can borrow more and spend more, right? That's what that means, in a very quick way of explaining it. And what typically happens to various asset prices, well, if everyone's spending more money in the economy, typically you get asset prices that bubble up, okay? But how do you prepare yourself for another opportunity? Well, when rates are high, right? When rates are high and you can make money, this right here on savings, this here encourages savings because you don't need to compete with the volatile stock market. You can get a good yield on cash reserves, cash balances, etc. Okay, yeah, you can still trade and be tactical and XYZ and create cool portfolios and all that stuff. But just understand that when you're looking at about a 5% return risk-free versus, a history of an 8% to 9%, I mean, you're talking a very small spread, but the difference here is a large amount of risk versus practically no risk. And then, okay, think back to the great financial crisis here in 2008. If you were saving up in this area all throughout here and you were saving and being prepared for the opportunity and something happens where the Fed pivots, makes money cheap again, something happens in the economy, whatever the case may be, a lot of various stocks, they fell to extreme lows. Well, if you had all that cash balance and savings, it created opportunities for those that were patient. And I'm just calling it out because, well, we're here, but we're over here, right? So we're back to these levels where we can save our money practically risk-free, and we got to prepare ourselves for a potential opportunity to come. There's always going to be multiple opportunities, but very few opportunities come around that are very gigantic, and we could be on the cusp of potentially a big opportunity to come. A lot of various names have been breaking down, creating, potential opportunities that on the next cycle, For example, like potentially small caps, right? Small caps have been getting completely crushed, but on the next bull cycle, if you're prepared and you have equity or cash reserves to be able to deploy them in various names, various sectors within small caps, whatever the case may be, you can be rewarded greatly. Where can we look for potential change in market breadth and when we could potentially start investing? Well, I like to add into various portfolios when we get, extreme levels, and that's when I add for just long-term stuff that I'm going to be holding for a very long time. But you can see here the Nasdaq record high percent index. This thing is getting smoked. This is on a weekly time frame, so I don't know if it's going to get it's going to close down here, but this is the 10-period EMA that I'm showing. So it's getting pretty smoked down here at around 15. And I highlight a few areas. That's when we get below 20 and then we cross back above 35. It has marked bottoms in the market dating back to, the 90s. And this time was an exception where we clicked quickly above it, and then you can see that that led into that was when something broke there in the financial crisis. So as we're down here, it could be opportunity, but if you want to be more patient, you wait for breadth to pick back up and show strength versus just kind of hop into weakness. You can also look at something like the Nasdaq Cohen high low. Times that we've came and got this weekly reading of 0.05 when we closed below there, it has marked bottoms. The most recent one was the October bottom. It's marked this little bottom where we saw rallies. This one, we saw a bounce, but then it kind of continued the trend. It's marked the 2020 bottom, the pandemic low. It's the Christmas Eve massacre bottom over there, 2016. This was back with the China stock market turbulence over here in the great financial crisis, and then multiple pockets leading up and around that area too as well. So that could be another tool for, in the tool belt. Another one is the old fool indicator. The old fool indicator, you're basically looking at a ratio line. Well, the ratio line's hidden. It's the purple one kind of in the background with the opacity taken down, but it's the Nasdaq composite relative to the total put to call ratio. And then we apply a couple indicators over here, the EMA 21 and EMA 50. And you can watch when they cross over, it tells there's a potential change in trend happening in the markets. And the last bullish one was over here where we kind of whipsawed back and forth, but it kind of led to a long market rally. And then we crossed over here. It is a lagging indicator, that's for sure. But, it could catch big trends, and we had the bearish crossover. It went down. We saw a rally. Oh, see, this indicator sucks. Oh, never mind. Boom, right? So if we start to get a bullish crossover, start to fly now and get some, whipsaws and start heading back up, that could be a potential sign there too as well. If we take a look at the S&P 500 on the weekly time frame, down 2%. This is a big move. We tagged into the lower weekly expected move as already talked about, and we're below that weekly 5 declining EMA. Remember when we were down here, we said, hey, when we get stretched out, look for snapbacks. Well, we got that snapback, but remember, it's still in a downtrend, right? It's still pointing down. Well, we followed down. Now where are we? Well, we're pretty extended from the weekly 5 EMA. So to get snapbacks, once again, it's more than normal to see a snapback. Okay, so be prepared for that as we're at the low weekly expected move. It's either going to be like, hey, let's just crash this thing down, consolidate sideways, or we're going to get a snapback and catch back up to the weekly 5 EMA. Because make no mistake, it is the most frequently tagged EMA. It's tagged very frequently. And every time we get extended from it, boom, it snaps back. Extended from it, boom, it snaps back. Okay. Let's take a look at the SPY 15-minute chart. I'm going to give you the updated daily expected moves and show you the weekly expected move and where we stand. Now, the last 2 days, we broke the daily expected move 68% of the time. If you think of it in terms of distribution curve, it closes within this risk range. This is what the options market is pricing in as forward-looking risk. Okay, so if you want a leading indicator of what risk looks like the next day, these are great tools. And if you, like I said, think of it in terms of a distribution curve, 68% of the time. Now, the 2 standard deviations, price closes within that 95% of the time. And then the 3 standard deviations, if it was way out there, which is beyond rare, it closes within those 99% of the time. So when we get outside of daily expected moves, it can create potential opportunities, but you got to very well manage risk. You can't just full boat it, one time, make a little money, and then, double it up on the next time and then lose money. And then all of a sudden you're like, no, it doesn't work. So where are we right now? The weekly expected move is at 411.75. You can see we tagged into it, right? We're right back home where the market price in risk. And if you're new to these expected moves, this was the largest one I've seen in a while. This was a $94 expected move. The week prior was $90, which was also one of the larger ones. And we tagged it this week and we tagged it last week. And the week prior to that was like $74 or $75 plus or minus. And I don't remember if we tagged it already, or tagged that or not, but you can just see it went from 75 to 90 to 95. And during that time, we also had VIX go into backwardation, which tells us, hey, be ready, right? Volatility is picking up. Okay, now I haven't made a video yesterday, so I want to follow up with what we talked about right over here, how expansion leads to contraction. We talked about, hey, we have higher lows, that's bullish, but we're in a bearish trend. The 5 DMA is still pointing down. The quarter to date is still down. We're below it, all right? So we had some bullish things as we're above the week to date, okay? And we had some higher lows. And we were contracting, and we said, what? If it breaks down from this low, it opens the door to come down to this low and potentially even lower. And if we get back above this high over here, well, that would open the door to obviously swing higher. However, we had to be aware that it was still in a declining 5 DMA environment. Well, we cracked down, and you can see contraction led to expansion. Now that we're in expansion, it's likely to see some sort of contraction in the very near future. So we bounce from this area. Perhaps, we'll see. Amazon reported after the bell, and it looks like it's doing fine right now. But remember, it was up, and then it was down, and then it was up. It's up back again. So we'll see where it opens. But going into tomorrow, this would be outside of the weekly expected move. Weekly expected moves, remember, 68% of the time closes within it, so it could potentially create an opportunity. Now, if we get some massive gap down, just be careful when that happens, because as we break from these expected moves, we can have more selling take place as dynamic hedging takes place. And you can think of it in terms of this: if billions of dollars, right, created this little range of risk, and billions of dollars end up being wrong, what do they have to do? Well, they have to change their positions, right? And selling can get more selling. Same as if we get way above, buying can put more buying, and buying leads to more buying. If we take a look over here, I thought this was kind of interesting. IWM, it's the first month of the quarter. It's actually already by its quarterly expected move here. This is what the market pricing as far as risk for the entire quarter. And right now we're down 7.13%. So either this thing is going to just snap and break hard, but I will call out this was prior support area and it was prior resistance. So if we are going to get a bounce here in the near future, I would start looking actually at small caps, because that could potentially see a little bit of a relief bounce. You got to be tactical, because if it breaks, right, if we start breaking down, then just watch out. But I'll also point that out with the NYSE McClellan oscillator. NYSE is obviously a broad market, correlates pretty well with IWM. We had this positive divergence forming over here, right? And we bounced up from that area. Well, we have another low, right? As price action's kind of just been just selling off. But what is the indicator telling us? What is the NYSE McClellan oscillator tell us? The internals, right? As price is breaking down over here, the internals are actually strengthening. So what that tells me is, hey, be prepared. We could very well see some sort of snapback, sort of rally in the very near future. And if you're paying really close attention, IWM, Russell 2000 has a lot of small cap, regional type banks, and those were actually up on the day while the broader markets were selling off, okay? And you can see small caps were actually up on the day. All right, let's continue on. I'll show you the summation index for the NYSE. This is actually 3 trading days ago, maybe 4 trading days ago. It clicked a sell signal again. All right, and we started selling off. We had a buy signal. Prior to that, we saw, let me see if it should just draw a straight line up. Do this. I kind of saw some chop, and we even discussed like, hey, careful for these little, hooks to hook back like it was over here. But the trend according to this is still bearish. But if we start upticking, wait for the parabolic star to uptick, and it could eventually lead, right, to a longer term type trend where we have a longer term uptrend, boom, or a longer term, obviously, downtrend when we see the shift take place. And if I take a look at the NASDAQ Nation Index, this thing is getting smoked, man. We're talking about, we're over a minus 1,000 reading. Just look back to the left of the screen. We haven't had a reading this low since actually the October low. So this indicator is getting weaker and weaker. And you can see that we are still on that sell signal. It was a buy signal, then a sell signal. So wait for this to see if this turns back up. We're pretty extended, so to see a bounce or some sort of snapback makes sense. And then we also have, as we're making new lows over here, we have that positive divergence forming in the NASDAQ McClellan oscillator there too as well. Well, that's all I got for you on today's episode, everybody. If you want to check out the swing trading community, as it stands right now, right, we're more on impatience mode as we're below that declining 5 DMA. But once we're above that, I usually typically post more trade ideas. I post my watch list every week. I give daily expected moves, weekly expected moves. You get access to the community. And then you have a whole host of, order flow type bots like dark pools, golden sweeps, large sweeps, kind of options flow. And then you have access to a query channel, which you can type in certain commands and get various charts and stuff. That's all I got for you on today's episode, everybody. See you later.